Business Council in Dubai and Northern Emirates.
So good morning, ladies and gentlemen. I hope you all are keeping well and safe. Indeed, it's a very lovely, sunny and pleasant Saturday morning here in Dubai, and I really hope that it's the same wherever you are, in Abu Dhabi, or even if some of you are in Sri Lanka. Thank you very much for joining us today. I hope it's going to be an extremely important webinar on the trending and useful topic of UAE Corporate Tax, which is going to be introduced soon. So this webinar is organized by the Sri Lankan Business Council, and it's presented by MCA Gulf. Again, they've very kindly volunteered to host this, so thank you very much for that. And the session is expected to take a little more than an hour from now, where there will be a presentation and then a question and answer session at the end. During the session, participants will be on mute to avoid any disturbance. But if you have any questions, which I'm sure you'll do, as many of us do on this new topic, please feel free to send them on the chat or raise your hand on Zoom, and we will take them at the end of the session. Just to also let you know that, as you can see, this session is being recorded so that it can be used for future reference. Before proceeding with the introduction of MCA Gulf and the webinar itself, let me kindly invite the chairman of the Sri Lankan Business Council, Mr. Suren Swaminathan, to welcome you all. Mr. Suren Swaminathan, it's over to you.
Thank you very much, Shihan. Your Excellency, MCA staff Girish, and all the other members who have joined, friends and members who have joined, warm welcome and a very good morning to all of you. I know it was a very short notice because it was getting postponed. But as we had so many events coming up, we didn't want to postpone this anymore, and Ramadan was coming, so we wanted to just have it, finish it off and then have a second session if required. There'll be other changes that are coming in, because still I know that changes are coming in. And to have another session after some time so that we'll all be well versed with the current taxes, because I think UAE is the first country to introduce corporate taxes. And this was very new to us. Even in my field, insurance, it was very, very new, and I know that it's going to help my clients, in my advice to the clients very much. So that's what it was very interesting for me also to come and participate in it. So Giresh, thank you very much for agreeing to do this, and Afka, thank you very much for arranging this, because it was Akbar, our finance director, who took the initiative to arrange this session for us. Before I hand it back to Shihan, sir, would you like to say a few words? Because you have taken off and come to attend this session.
You're on mute, sir.
Good morning, Chairman, as well as all the members, as well as other Sri Lankans who are joining. It's a great honor and pleasure again to at least virtually meet all of you. This topic, actually, yesterday Mr. Swaminathan was telling me at another event which we conducted to promote Sri Lanka. Even though it's not directly a concern for the embassy, but I think it's good for our business community to know the new laws. Now, I know that UAE has been drastically changing so many laws which are also affected even our expatriate community, that is the labor laws. So far, actually, I'm looking forward for a lawyer, a Sri Lankan origin, most probably, who can speak 3 languages, who can actually maybe through your platform that give some advice to our Sri Lankans, fellow Sri Lankans. That will be great, Mr. Chairman, if you can consider that. Having said that, this is also very important for our business trade. In the meantime, just want to let you know, we are winning one by one. Actually, we are hitting goals in UAE. That is because all pending MOUs are being slowly we are getting signed off. So that is one of the greatest things, and one is very important one for all of you as well as for Sri Lanka. That is an investment protection and promotion agreement that has come to the tail end after so much of negotiation since I came. Only on one clause is standing, that is the arbitration clause, which we are working at the 23rd. I have another meeting with the Ministry of Foreign Affairs legal department. Having all this actually going on in the background, I think we have a lot to do as a community and Sri Lankans outside Sri Lanka, because there's a turmoil in Sri Lanka. We all understand that. We all know that. It's not a blame game. It's a game that we have to play to protect our country and bring back our country to our own feet, to stand up. So I urge and each and every one of you as Sri Lankans to get together. You may have different ideas, different opinions and all those stuff, but we can conclusively at least assist in some way. That will be the greatest thing you are doing at this time for our country. So if there's anything that you wanted to discuss with me with regard to your suggestions, I mean, we feel that it should be done this way, because you're a business community, but not each one. The committee, the business committee as one, the Sri Lanka Business Council can come and then discuss with me. I can pass that on to, directly to the very higher rankers, not this, I can call in Hindi, chota motas, no chota motas with me. I go to the top. So please let me know. Other than that, have a pleasant day today, and hope that we all gather some good information. And if necessary, this recorded message can be actually put into our website. So that way it can be reached to many more Sri Lankans who are planning to come to UAE to do business, as well as people who are doing business in UAE. Thank you very much. Have a pleasant day. Thank you.
Thank you very much, His Excellency, the Ambassador of Sri Lanka to the UAE, Mr. Malraj De Silva, and also Mr. Suren Swaminathan, the Chairman of the Sri Lankan Business Council, for those opening remarks and the welcome. So let us now move on to the presentation itself. But before that, let me kindly introduce our presenter today. He is Mr. Girish Chand, a senior partner at MCA Gulf. He heads the compliance practice, including VAT, ESR, and AML, quite serious stuff in there. He has got over 30 years of experience in compliance, C-level finance, and audit executive roles. He has addressed over 200 seminars on VAT, ESR, and AML topics, and is a regular contributor to UAE newspapers on VAT topics. If you follow him, you'll see his name quite often. During his corporate stint, he has been in advisory roles to the senior management and the board on financial and compliance matters. His varied expertise in taxation in particular, financial management, GRC, and compliance not only helps clients to have a holistic perspective, but also on their advisory requirements, it helps them a lot. In terms of qualifications, Mr. Girish is a chartered accountant from the Institute of Chartered Accountants of India, certified information system auditor, and Bachelor in General Law. He has spearheaded MCA Gulf VAT practice since 2017, and also taking the lead on ESR and AML verticals during this time. During his corporate stint, he also held the roles of CFO for leading oil and gas government entities in the UAE. as well as various other roles that he's handled, including finance, internal audit, leadership, and so on. In terms of expertise, as I mentioned throughout his profile, compliance management, including ESR and AML, VAT, JV structuring, and board dealings are his core expertise areas. And in terms of geographical areas, he's covered UAE, Bahrain, Oman, and India, so primarily the Gulf. So without further ado, let me kindly call upon our presenter today, Mr. Girish Chand from MCA Gulf, to present us on this important topic of UAE corporate taxes. Over to you, Mr. Girish.
Thank you so much, Shihan. I think you have been very kind. In fact, I did not know that there was so much in my profile as such here, but I think you have done some research also. Right, so thank you so much. It's such a privilege to address the Sri Lankan Business Council, and to have the ambassador in this meeting is my additional privilege. Thank you, sir, for being part of this seminar. Right, let me at the outset basically congratulate all of you. I think it's a Saturday morning, and to get so many people to come, thank you so much for basically sparing your time for this presentation. Like I think, basically Mr. Suren has mentioned, basically the corporate tax is possibly the new legislation which is coming. Okay, we have been through a VAT regime which is now settling, and I remember the days when VAT was introduced. Okay, there was a similar kind of apprehension, confusion in terms of what is going to come. Right, we have currently limited kind of information as far as the corporate tax is concerned, but corporate tax is not something new in the world. It has been in the in many parts of the world, as well as in the GCC. Quite a few countries have got corporate tax. So my presentation today will be primarily into three sections. I will talk about what do we know so far as the UAE corporate tax is concerned. The second part of the presentation is drawing parallels to, I've taken representative countries which are closer, which is KSA and Oman, and seeing that, how is the corporate tax structured in those countries, so that we get some additional info besides what has already been said about the UAE corporate tax. And the last part of the presentation would focus on how do we basically prepare as far as the corporate tax regime, when the corporate tax regime comes in. So if you allow me, let me share my screen. Yeah, Shihan, the screen is visible, yeah?
Yes, it can be seen.
Great, thank you so much. Okay, so like I said, primarily we will be talking about these three topics. Okay, the corporate tax introduction, the GCC comparison, and how to prepare. And at the end, of course, the floor would be open in terms of the Q&A. Right, so what do we know so far? Right, now primarily when we talk about corporate tax, right, it is something which is basically levied on the net income of the enterprise, right? That's the slight distinction on VAT, which I'll talk about a little later. Okay, the question arises, why has UAE introduced it now? Okay, the expectations were that possibly it would be introduced at possibly a later date, right? But what has happened is that, as you guys must be aware, that because of the OECD related regulations, there was a, I would effectively say, an opportunity rather than a compulsion, because what was happening is that because of the new guidelines of OECD, right, where there are the MNEs, effectively it gave the country or the where the company is resident to kind of levy tax on the entities or the related parties in other countries where there is no taxation. Okay, so effectively, I think UAE would be losing out if it did not have the corporate tax in place, and that is where one of the compulsions and why it is come as effectively in 2023 is because the OECD regulations are kicking off from 2023. Of course, it would help UAE in terms of its development and its basically to achieve its strategic goals, right? And as you will see during my presentation, they have taken the pragmatic approach of doing this very gradually, right? So, and you will see how when we compare against the other GCC countries, right, how it has been pragmatic as such. Now, what a normal question which gets asked is, how is it different from VAT? I think we would have all seen that as far as VAT is concerned, if the company is efficient, okay, and it does not have exempt related supplies, there would not be any impact on the entity as far as the VAT is concerned, because effectively it is a pass-through tax. If you act as the agent on behalf of the government to either collect or pay. So whatever you're collecting is what you're paying, and whatever you pay is what you kind of deduct. So net impact is kind of zero on a VAT front. But when we talk of the corporate tax, there is definitely an impact on the bottom line of the company. Okay, so you would be paying the tax on the net income. Effectively, again, we'll see that it is not the net income that currently we are drawing up through our financials. Yeah, because the corporate tax would have different rules as far as treating income and expenses. Okay, these are some basics in terms of the dates and stuff. So, we have seen this, that it is basically for the financial year starting on or after 1st June 2023. So, what does it mean? Okay, so effectively, if an organization has got its financial year as 1st Jan to 31st December, in that context, it will basically the corporate tax, the financial year would commence from 1st Jan 2024 onwards. So it is not that it would be from 1st June or you need to pay for half of the year of 2023. If your financial year is Jan to December, it would start from 1st Jan 2024. And what happens in case of if the financial year is 1st April to 31st of March? In that scenario, your financial year for the corporate tax would be starting from 1st April 2024. And it would go, of course, till 31st of March 2025. Right? I think this naturally brings a question that should you be changing your financial year so that you take, like effectively when you say 1st June, right? So you could possibly get a 6 to 9 months reprieve from the corporate tax regime, right? So that is a natural question. Of course, we are basically advising our clients to be prudent at this stage. I think the laws have to come up because any law, when it comes out, it has transition provisions, right? So we need to carefully look at the transition provisions to basically understand whether there is going to be an impact. So I think a change in the financial year is not advised at this moment until the law comes out. So the basic in terms of the rates and stuff. So what they have said is that as far as the income, the net income, again, let's remember is next taxable income, right? As long as the net taxable income is below 375,000 dirhams, it would be 0% taxation. And you would have basically the tax rate applied beyond 375,000 at the rate of 9%. The announcement also talks about an higher rate for MNEs, okay, primarily in line with the OECD guidelines, right? So in case of MNEs which are having, the turnover in excess of euro 750 million, there is an expectation of higher rates. And indicatively, if you look at the OECD guidelines, it may be around 15%. So if we take somebody earning a net taxable income of 500,000, how would the corporate tax apply? So what we would see is that, the first 375,000, it would be 0%. The balance 125,000, the tax rate of 9% would apply. And that's why the net tax that the entity would be required to pay would be 11,250. Now, to whom it is applicable? Basically, the law provides for all entities, businesses and commercial activities okay, except where there is the extraction of natural resources, right? Now, they have basically excluded individuals as long as there is no requirement of a license as such. Okay, and what they have mentioned is all activities conducted are basically subject to the corporate tax and they would be deemed as business activities. Now, banking and real estate basically also will be subject to corporate tax. As you may be aware that currently the banks are exposed to an emirate level taxation, right? So we need to see how that will work. Is that effectively, would it be a case that they will all be now subject to just the corporate tax, or there would be some credits given as far as the emirate level taxation? So foreign entities and individuals, they, like I mentioned, basically only if they are conducting a trade or business in the UAE on a regular ongoing manner. So I would imagine that where you are having effectively the trade licenses and stuff as an individual, if there is a requirement to have trade licenses, then in that case, you would be subject to corporate tax. Now, like I mentioned earlier, that's a pragmatic approach. So what we have seen here is that in terms of the foreign investor, any income that is being generated from dividends, capital gains, interest, royalties, and all these, they are not subject to the corporate tax in UAE. I think this is a question which gets asked frequently in terms of free zone taxability. Okay, what they have currently said that all the free zones are expected to be registered for corporate tax, right? Basically, they have also said that primarily the free zone related regulations on taxation would be respected. But I think I would just draw your attention to one point is that originally and the intention of free zones are primarily talking about dealing in free zones and, dealing outside UAE, right? Now, yes, there has been possibly the business practices in terms of dealing with the mainland. And that's where they have put in a line saying that if the free zones are dealing with mainland, then in that case, that would be basically subject to tax. However, we await the details in terms of how that's going to happen, especially in cases where a free zone deals with both the, outside the UAE and also with the mainland. Now, what is it paying? As I mentioned earlier, that it is basically payable on the net taxable income, right? It does talk about that, as far as losses are concerned, those will be allowed to be carried forward. Obviously, the losses only after the corporate tax becomes effective will be carried forward and not something which losses prior to the implementation of corporate tax. And they basically talk about that there would be a credit available for the foreign corporate tax, which is paid in other countries for the entities which are established in UAE. So basically, again, this is one more where we spoke about is that the dividend and capital gains are basically not coming within the domain of capital tax. So in case of holding company structures, if they're primarily their income is just derived from dividend and capital gains, those would not be subject to corporate tax. Similarly, there is no withholding tax as far as the payments which are made to foreign entities for services as such. So that's again one pragmatic approach which is adopted as compared to the other GCC countries. Now they talk about a tax group as such. There is a provision for a tax group, right? In the VAT regime, we understand tax groups as from a perspective of, having majority control or basically control over the operations, right? Now it remains to be seen that in the corporate tax perspective, whether it would be a similar definition or, normally what we have seen in other parts of the country is that generally for tax groups, they talk about substantial holdings, and the substantial holdings are in the region of 75% and upward. However, we still await the kind of regulations on this. They have mentioned that transfer pricing would be basically applicable as per the OECD guidelines right now. So that would bring the focus of, intercompany transactions into the, fray, right? Because now we will have to also report on in terms of how the intercompany transactions are being conducted Is there an arm's length dealing available? Right. So those kind of things will happen. Later in the presentation, we look at the other countries, what kind of compliances are required as far as the transfer pricing is concerned, more from an indicative perspective. So I think here is one example that I just put up in terms of how the calculation will happen. This is basically an indirect method which would normally get followed, right? So if suppose you have kind of got your audited, income statement, and as per that audited income statement or the income statement generated by the accountants, right, the net income is 1 million. So what would happen is that that would not be the value on which you'd be paying the corporate tax. So in that, then again, there would be a look at whether, do you have any exempt income like dividends and capital gains, right? So if there are any kind of those exempt income flowing into the P&L, right, those you can deduct it. Okay. Similarly, cases of possibly, allowed expenses where if the depreciation rate is higher in the corporate tax regulations, right, as compared to yours, so the differential additionally can be taken out. So those can be reduced as far as the net income is concerned. Also, there is the thing of certain disallowed expenses. Obviously, personal related expenses, possibly the depreciation rate is lower than what you are charging in your accounting books. So those will be kind of added back, right? So that would bring us to possibly say that the income which is subject to corporate tax is 850,000. In this example, possibly it is better off, right? So basically, that's how we will have to rework the net income and the tax calculation. Since the net income is 850,000, okay, the initial 375,000, there will be a zero rate, and the balance 475,000, there will be a 9% applicability. So the tax which is payable, it would come to 42,750. Hope this kind of gives you an understanding. I think I've kept it simple, just so that I'm able to explain the concept of how the calculation will happen. Okay, in terms of compliances, primarily they have mentioned that it is the same authority, the Federal Tax Authority, that will be responsible for the administration, collection, and enforcement of the UAE corporate tax, and the Ministry of Finance will remain the competent authority for, basically the overall kind of supervision and basically for the international exchange of information. There is a requirement that all qualifying entities, including free zones, will have to register for corporate tax. There will only be one return to be filed on a yearly basis. There is no requirement of advance tax. Of course, the usual we are familiar with in terms of the penalties for non-compliance. So the usual penalties would apply in terms of being non-compliant to the regulations. I will now move on to the second part of my presentation, where we basically are drawing a parallel to how does corporate tax operate in the other jurisdictions in the GCC. So we have drawn basically parallel to KSA and Oman and seen how does it work. So when we talk about KSA, as you might be aware, is that when we talk about Saudi nationals and GCC nationals, they are subject to the zakat regime, whereas non-Saudi and non-GCC, whether they are entities or whether they are individuals, are basically subject to corporate tax. In the Oman context, they talk about companies, enterprises, branches, and foreign entities undertaking business in Oman. This is something which would be very similar to what UAE is basically talking about. Employment income, thankfully, the salaries that we are earning currently, they are not being subject to corporate tax, neither in any of the GCC countries. Okay, just for a reference, the rate of tax as far as KSA is concerned is 20%. Zakat has a rate of 2.5%. In Oman, there is a flat rate of 15%. And for the certain specified SMEs, there is a rate of 3%. We have already been through what it is in UAE. right? And this is the element that I think possibly we need to get used to, is what is allowed, what is disallowed. So when we look at in KSA, all business related expenses, depreciation as per the regulations, business setup, interest expenses subject to certain restrictions, largely related to related party loans. Bad debts, of course, bad debts are, I think it's a similar regime in VAT where, effectively bad debts can be allowed as expenses only when they are written off and not when you provide in the books. Okay, employers' contribution to the pension funds, R&D expenditures. So these are all examples of allowed expenditure. This is similar in Oman. Possibly additionally, Oman, I can highlight, is the sponsorship fee payment to Omani sponsors and certain expenses allocated from head office. These are something that is additionally allowed. In UAE, obviously, we are awaiting the details. Now, generally, there is the element of non-deductibles, like we saw in the example. Okay, so in case of fine, penalties, local income tax, interestingly, this is a bit, and this is what we have to watch for, is that in case wages and salaries paid to owner, partner, shareholders are disallowed. Of course, entertainment expenses are, entertainment and personal nature of expenditures are also disallowed, and payment to head offices are disallowed in the KSA context, while in Oman they are allowed. In Oman, similarly, fine penalties are there. Interestingly, in Oman, you have, the amount paid for tax consultancy or advisory services basically is disallowed. Okay, not good news for us. So UAE, of course, we need to see what they would provide for disallowances. Now, the carry forward losses, just a comparison of KSA and Oman. KSA allows the losses to be carried forward indefinitely. However, it does basically provide for a 25% limit, of the tax adjusted annual profit in terms of what you can take as the maximum loss in a year, right? Basically in Oman, the carry forward is only for 5 years. Right. And basically, in certain cases, they allow the losses to be carried forward indefinitely. In UAE, they have mentioned that they are likely to have generous loss utilization rules. We need to see, but that would possibly indicate that they could allow the losses to be carried forward indefinitely. Withholding tax, like I mentioned, UAE does not have withholding tax as such, but as you would see in the KSA context, there is withholding tax on the various fees like management fees, technical consulting, dividends, interest, royalties, and they vary from 5 to 20%. In the context of Oman, the rate is 10%, and these are the various categories like royalty, R&D, IP related, management fees, and also related to services that are provided to outside parties. The foreign tax in KSA is limited. Oman has got foreign credit, however, is limited to the extent of Oman tax. UAE is supposed to have, liberal kind of thing on the foreign tax credits. We await to see how that will be applied. So, like we mentioned, transfer pricing is something that would basically come into play, and UAE is going to follow the OECD guidelines for transfer pricing. Just to give you a flavor, when we talk about KSA, there is basically, when you talk about related party transactions above 6 million, there is a requirement to maintain the master file and the local file. Okay, Oman doesn't have such requirements. However, we expect that as far as when you look at from an OECD guidelines, maybe the transfer pricing thing would be having the requirement of keeping these files, and maybe there could be requirement of certified statements to be submitted. The due dates are similar. I think they are generally within 4 months of the year end that you're expected to do the corporate tax filing as far as KSA and Oman is concerned. KSA has an advanced tax, kind of regime where effectively you need to pay advance on the 6th, 9th, and by the 12th month of the tax year. Oman does not have any advance tax, similar to UAE. And fines and penalties, basically the similar structure of, maybe a fine of 1% for each 30 days of delays. Tax group are in cases available only for zakat, whereas in Oman, they do not have the tax group concept. UAE is going to have a tax group concept. And these are about the statute of limitations. Maybe these are not so relevant. Yeah, this is a slide which is maybe that we need to pay attention on. Okay, because right now, when we get into the corporate tax regime, I think what we have to remember is that the authorities will be kind of, cross-checking with various data that is already available with them. So let's remember one thing is that as far as the VAT is concerned, it is the same authority, Federal Tax Authority. They already have our VAT details for possibly 3 to 4 years, right? The other part of it is, like you can see in the KSA context, they tend to compare the, the payments as per the government records for wages with the, with the records that you would be submitting for corporate tax. I would imagine that in the back end, similar thing would happen, because here also we have a WPS system and we would be paying the salaries. And so what we are reflecting in our books and what is being the WPS system, those would be of relevance. Also, there is the element of KSA talks about the comparison of the import related records. So similarly here also, we would have to keep in mind that we have the customs and we are declaring the value in the customs, right? So what do we show as our imports values in our books? So these are some things that would now come into basically into focus. And these are something that we need to be aware of, and we need to have control systems in place for those. In the context of audit, there is a requirement for audit where the taxable income exceeds 1 million. Okay. Similarly, there are requirements in Oman in terms of audit. Yeah, UAE is yet to specify what those requirements will be. I will now move to the last part of the presentation in terms of talking about how do we prepare for the corporate tax as such. Yeah, there is always a question, is it too early, or why should we prepare now? Okay, so maybe I can address few of these questions here. Right, so generally is that the question is why bother now? Of course, we talk about the key risks to avoid and what is the corporate tax implementation methodology and what are the phases of implementation as far as corporate tax is concerned. So I think this is just putting, possibly like the arguments of why we need to bother now. Right. Obviously, when we talk of the region, there is practically zero experience on direct taxes as such. Okay. One of the common things that we see is that when we talk about the accounting and auditing practices, there is a varied degree, right? There are very few free zones which are insisting for audited accounts. Okay. So basically in terms of the discipline on accounting, is very, very varied. Okay. And so that's something that possibly the organizations need to look at. As we have demonstrated in the example, it starts becoming an exercise of looking at your accounting profit and then calculating, the taxable profit. But more importantly, I think for business people, it's about your sustainability and profitability. Obviously, like we mentioned, there is a straight impact on the bottom line of 9%. So the question arises is that, okay, how do we kind of basically mitigate this additional burden in terms of your outgo part of it? So obviously you need to then draw strategies about how do we kind of mitigate this, whether in terms of your pricing management, also possibly the cash flow impact, because one of the things is you generally see that organizations say, fine, this is at the year end I have to pay, but year end we have to remember that it is payable on your entire profit for the year, right? So obviously there is possibly a cash flow impact when you need to pay this, right? So that's something that you need to consider. And more importantly, now the onus is always on the business in terms of proving that the numbers that they're giving are the right numbers. So which brings into focus the system of recording and documentation. I think there's one element of thing which, at least the thought process can begin in terms of structuring, because we are seeing that there are certain, differentials available, certain, kind of exemptions given. For example, the relating to the, free zones, relating to the dividends and capital gains. So the part here is that at least we can begin our thought process in terms of how do we structure, especially when we have got multiple entities. Of course, the usual part is what the risk to avoid, that you don't prepare, right? You do not understand the legislations and requirements. Okay, you do not understand the tax treatment for the transactions, right? That you are, basically, like you mentioned and emphasized so far, is that your control systems are not built for, the accounting, documentation, and the tax treatments. When we look at methodology, I think this is a very standard thing that organizations would adopt, is that you need to look at the structure. Is there any system changes that you need to do? You possibly need to look at, in terms of your transaction process. And important element is depending on the size of the organization, the training and communication to the to the people in the organization is something that you would need to consider. We just chalked out possibly the corporate tax implementation journey. Now we talk about possibly organizations doing a kind of a preliminary impact assessment till possibly the legislations come out. Once the legislations are out, we are expecting in the mid of 2022, right? We possibly need to do a detailed impact study, right? Now this is considering somebody who needs to kind of start reporting for corporate tax from 1st June 2023, right? So then we talk of the implementation phase being the Jan to June 23. And post June 23 is where the return filing compliance would come into play, right? So when we talk about the preliminary impact assessment, it will be hovering around the structure, the grouping, the tax applicability. You would also look at how your intra and intergroup transactions are structured. Okay, this is one important which tends to happen in the SME sector, is about the management related transactions, whether in terms of remunerations or whether in terms of, basically related party purchase and sales, right? What is the impact likely on your bottom line because of the tax? And let's remember that is not what is your net income currently, but what is your likely taxable income. On the detailed impact study, once the laws are out, then we can basically look at our structuring and grouping, clearly, and have a clear understanding of the allowable and disallowable transaction. Important part of it is start the process of, seeing how different are your records from the government records. Okay, transfer pricing and related implications. These are more applicable for group entities. We spoke about it. Once the law is clear, we need to see what is the impact on the management related transactions, right? And again, now we would have a more clear idea about the bottom line impacts. Implementation is then getting into the phase of actually doing the changes in structure, whether in process and systems, right? The intergroup transactions, basically related to management transactions, and yeah, of course, then what would that impact come about? And obviously, if you are required to register, then you start the process of registering for the corporate tax. Return filing, the usual stuff about that your accounting and documentation is in place. You have performed the reconciliations with the government and statutory records. Obviously the computation of the tax suggested net income, and the final step in terms of filing of corporate tax returns. That I come to the end of my presentation. Thank you for being a patient audience.
Thank you very much, Mr. Girish, for that very comprehensive presentation. I think you've covered all areas within the limitations of the information that is available. whilst most of the regulation is yet to be announced, but I think it gives a good heads up for all business owners and senior professionals who are here with us on the webinar today. So whilst I'm sure there will be a number of questions, would like to thank you very much for your time on this important webinar and this timely topic. So just to kick off the Q&A section or the session, let me just ask you, in your opinion, when do you think the rest of the legislation would be announced? I know it's a difficult question for you to answer, but based on your experience, when do you think the announcements will come in?
Yes, it is a difficult question, but what they have indicated is that by mid of June, the law will be out. And as we know from the VAT regime that there is first the law and then subsequently the implementing regulations come out, right? So the law would give you, I would imagine you would get to possibly a 60 to 70% in terms of knowing the stuff. Right, and then maybe there will be still some elements of it which will be still be awaiting the implementation regulations, which may be another 2-3 months, but it is like gazing into the crystal ball.
All right, thank you very much. So those who have got questions, please feel free to raise your hand on Zoom or send it through on the chat, and we can present them to Mr. Girish. So whilst we get a few questions, let me ask you one more question, Mr. Girish. My question. Yep. So when we say corporate tax, or when the announcement came in, most businesses and business owners were like kind of extremely negative about it, which is expected when that kind of an announcement comes in. In your opinion, what are the positives that we could take from something like this being introduced? So whether it's financial discipline and so on, so what exactly do you think could be the positives?
Yeah, nice. I think it's a very interesting question. Basically, when we look at it, yes, the first element is 9% getting impacted on the bottom line. That's what gets highlighted as such. Yeah, but I think there are a lot of businesses which are actually, kind of having good systems. They are following the rules, right, and they are doing the business in the proper manner. I think these are more beneficial for such businesses, where effectively it starts possibly creating a level playing field, yeah. Because currently then when we talk about corporate tax, there is more transparency in terms of the transactions, okay. There is a requirement of, possibly getting your, accounts audited. So the parallel is that when you talk about now dealing with the banks, right, dealing with in terms of your lending related requirements, now a lot of them are coming onto the mainstream in terms of having proper records and something that can be verified. Now, in most places, as you know, the banks would require your corporate tax filing, right? So now once that comes in, okay, so we are moving to a more kind of a regulated and, kind of more organized system. That's what I would put.
All right, thank you very much. There's a question that's come in directly. Let me just get to that. Okay, so before that, I think Hydros Jasim, you've asked a question on the chat itself. You can please feel free to unmute yourself and you can ask the question directly. I think this is a common question that most people do have, given the introduction of VAT, then ESR, UBO, and now corporate tax.
Yeah, so hi. First of all, let me thank Mr. Girish Chand for this excellent presentation. It was really very good and very informative. At least it's a starting point before the several layers of the onion kind of expose itself. So, I must thank Suren for organizing this. Thank you, Suren. So as we said here, it was first the VAT and slowly it's come to corporate tax, which was expected. So my question is, as of now, we don't have any clarity on any taxation on individuals. Is that correct?
Yes.
Yeah. So right now, the taxation is only on the corporate income and not on any income tax on individuals.
That's right.
Yeah. So,
right. But
carry on.
Just to add that when you talk about individuals, possibly if there is a requirement of a license, yeah, where there could be like either whether it is a freelance related or maybe related to real estate, right? Where there is a license requirement, possibly that would come into the regime of corporate tax.
Yeah, more like a service-oriented
Yeah,
consultancy and things like that, probably.
correct, correct.
Yeah, yeah. So suppose a small, so this is applicable to every business, whether it is a small cafe on the street side and a big business. Is that correct? Am I correct?
Yeah, so they are basically saying all of them qualify. Now, we need to see the regulations in terms of requirement. My current understanding is that everybody is expected to register. Now we'll have to see whether if you are below the 375,000 threshold, is there any way that you would get an exemption? Okay. And see, again, the part comes in is that how do you prove the exemption? Yeah. So we'll have to wait and see if there is, whether they would get kind of a certification and give exemptions where your income is likely to be below 375,000, or you'd be expected to file and say that, no, you declare that I have, my income is below this level.
Okay. So that was just for, I was wondering whether there was any clear definition on when they're saying corporate tax, businesses below 5 people are exempted or something like that, to just kind of take away that smaller businesses out of the picture, which is quite cumbersome, because businesses like that, there are like hundreds of thousands of these small entities who have never had any exposure to any kind of tax, So I was wondering how they would manage, that's all. And as a small business, suppose if in an LLC company, so if the managing director, who is also a shareholder, so if he draws a salary apart from taking a profit of the company, so is that salary subject to a tax?
No, so the salary of the individual is not subject at the hands of the individual. Okay. Now, what remains to be seen is that whether that salary will be allowed as an expense in the entity.
Correct.
Okay, because these are managerial remuneration. So, and these are basically, as you would imagine, that there is no kind of a guideline, right, as to what salary you can draw. Okay, so obviously the taxation perspective, they would always look at, is there a way to bring down the net income that you're reflecting?
Correct.
So there will be guidelines around that.
Okay. Thank you for that.
Thank you, Mr. Hydra, for that question, and Mr. Girish for the explanation. So I can see we're entering a very interesting area of creative accounting and tax planning now. But of course, all should be done within the guidelines and parameters.
Absolutely.
Moving on to the next question, I see Mr. Farooq Qasim has raised his hand. Mr. Farooq, you could please proceed.
Yeah. Good morning, Mr. Girish. I just have 2 questions. One is that will there be a lot of companies crossing over to free zone if there's no tax in the free zone? Also, we have been hearing from the market that a lot of people are not paying their VAT in proper, and a lot of cash transactions are taking place. You think this will happen for the corporate tax also?
So I think there is always, it's a case of possibly the mindset here. So I think we can never discount this mindset. So I think that's true in any kind of any country and any regime, right? In terms of people trying to do this, but as we know, the laws here are much more stringent, and obviously, when you do such things, the risks are also associated with it. So I wouldn't like to comment on where what is the extent and what are people doing. That's an individual choice. How they take this about as such.
I have crossing over into the free zone. Do you think that will also happen?
Sorry, the free zone part of it, currently what is available. Okay, they have given 2 messages. One is that they would honor all the free zone related tax commitments. Okay, and they have basically said that if you're dealing with the mainland, you would be subject to corporate tax. Okay, so what happens is that then you're looking at 3 components. You're looking at a component where the free zone is dealing outside the country. You're looking at a component where the free zone is dealing within the free zone. And there is a third component where the free zone is dealing with the mainland, right? Now, if entities are primarily doing business in the first 2 components, right, at least my guess would be that they would not be subject to corporate tax, although you have a requirement of registering for corporate tax. Yeah. So they would not be subject. Now, when they deal with the mainland, right? Now that is the bit of clarity which needs to be assumed. Let's take an example that possibly 20% of the business is with mainland and 80% of the business is either in the free zone or outside the free zone, right? So what remains to be seen is that would you then do a calculation and say that on the 20%, basically you need to kind of do the calculation and say that this would be subject, or is it the entire thing would be subject to corporate tax, which I don't think so. Yeah. So, but those guidelines are awaited as to how do you basically qualify this mainland business. So again, the structuring comes in is that if you have multiple businesses and with, multiple transactions, that's where the element of structuring would come in.
Oh, so
Thank you, sir.
I was under the impression that the mainland taxation was only if the free zone company had another mainland establishment. Is it? Oh, it's not that way. Okay, so we have a free zone company.
Yeah, because you see, and that is again the essence of why the free zones were established, right? It just happened to be that business practices have evolved to the free zone entities dealing with the mainland entities, right? So I think the protection which is offered is largely related to transactions which are in the free zone or outside the country.
So if we have a business where, say, at least for our business, only 5% is what we sell to UAE, 95% is exported. And maybe say if you take the entire GCC, only 10% is say in GCC and 90% is exported, manufactured and exported. So then you are saying that there could be a tax portion on the 5% that we're doing with UAE, or possibly the 10% that we're doing with GCC?
No,
And
what I'm referring to is
of,
let's hope that it is only on the 5% that you do with the mainland.
With
entity.
the mainland. Okay.
Yeah.
And there could be a separate component for what business you're doing within the free zone itself. Like whatever you're buying in the free zone, there could be something or no?
Yes. So now we can draw possibly a little parallel to VAT, right? In the VAT context, if we talk about the supply of goods within the free zone, right, and if it is basically used not for consumption, then the VAT does not apply, right? If you render services in the free zone, right, in that case, the VAT applies. Okay. But on the corporate tax perspective, yes, will they follow the VAT kind of, the guideline, or will they basically kind of stick to, what they have said that if you are basically, you will be honored in terms of your tax related thing? Because, when you talk about even the customs, right, it doesn't matter whether it is a consumption or what, right? I think that, in the customs also it's similar, where you talk about a transfer of ownership within the free zone. If you are, kind of transferring the goods to entities. Yeah.
Thank you very much.
Thank you. Really appreciate it.
For the few questions, that's clarified a number of doubts. But
I think Mr. Suren wants to say something.
Yeah.
Giresh, I want to just find out now in the Western world, when it comes to insurance, they always charge it to the company and then they pay it to the company and it's not taxable. Now with the UAE one, you said personal will be counted. Will be recounted for the taxable thing. Is it clarified, or still insurance will come as can be a deductible from the tax?
Insurance, if it is related to the guideline is business expenses. Yeah. So anything of the nature of business expenses, right, those will be deductible. Sorry, your question was relating to personal insurances?
Personal insurance where the company pays for, say, its owner. They pay through the company for
that again we'll have to wait and see, because it's in the nature of possibly not, required for business purpose, right? So if you look at the VAT also, right, as you're familiar with, in the VAT context, when we talk about the insurance, right, the medical related insurances, okay, now only it is allowed in Abu Dhabi. As far as in Dubai and the Northern Emirates, it is not allowed as a deduction for, sorry, the dependents. I think it's only the basically related to the in the employee, right? In Abu Dhabi, it is allowed for dependents, right? So now, if we draw the parallel, I think the key question will be that is it something that is required for business purpose? So if you talk about personal related expenses, maybe the HR has been really benevolent and they allow the personal coverages, right? Maybe it is not required under the law to cover those.
What
So
I'm talking
those-
about, key man insurance.
Sorry?
Key man insurance.
I think key man would be basically key personal. Yeah, that is, when you talk about key man, maybe it is not a requirement in the law. It's more from a company perspective for their own protection, right? I would reserve the judgment on key man insurance.
Thanks, Ganesh.
Just another question that's come through. So, Mr. Girish, when we spoke about the tax rates, where it's going to be 0% if the net taxable income is below 375,000 in particular, which I think can affect most of the small to medium-sized businesses here. Will it be a requirement? So when we say 0% is different to saying there is no taxes, right? So when we say 0%, does it necessarily mean that a tax return will be mandatorily required to be submitted or not required?
Yeah. So I think I can only take a guess as such. Yeah. So at this stage, I would imagine the way they have put in is that because they said that all, kind of qualifying, entities will have to register for it. And the question here is, how do you prove that it is, it's below the threshold, right? So unless they have a kind of what we had in VAT in terms of, if you are doing purely a zero rated, right, you could apply at the start and say that I'm only doing zero rated and I want to be exempted from registration. So unless they bring something like that where they talk of a kind of an exemption, right, and with a certification process, because obviously there will have to be a certification process to establish that yes, you are below the threshold.
Yeah. So it's a bit like a jigsaw puzzle at the moment with lots of
it's not clear, but let's remember one thing, that when we say below the threshold, how do we prove that it is below the threshold?
Yeah, understood. So I think as and when the registrations come in, things will get clearer and we'll complete the jigsaw puzzle as such. And hopefully when we have that, probably we could look at another webinar at that point.
Sure. It's always a pleasure to address the Sri Lankan Business Council.
Thank you very much. And I hope everyone can please switch on your videos. We'll just take a few screenshots and photos. Whilst everyone switches on their videos, Mr. Girish, there's a question if the presentation could be shared. So aside from the recording, which we will also do, is that a possibility?
Yeah. I'll send the PDF to you all, and then.
All right. Okay. So that will be great. So we can share it with all members who can benefit from that presentation as well. Okay. I think few more probably can switch on if you wish. So I think that brings us to the end of the presentation. If anyone else doesn't have any questions, yeah, seems like there are no other questions. So thank you very much, Mr. Girish, for doing this presentation. I think it's benefited us and all the attendees a lot. It's given a heads up more than anything at all. So I think with proper tax planning and with the rest of the information coming in, hopefully we can achieve and be compliant with the regulations. That's the most important thing. Aside, also thank you very much to Mr. Hussein Afka, who's the Director of Finance, for initiating this webinar and providing this idea to the board to have such an event. So thank you very much to all those who've attended as well for spending your valuable Saturday morning with us. I'm sure it must have benefited you, and it will also continue to trigger more and more questions, I'm sure, no doubt, but that will only help you in planning your corporate taxes for the respective businesses going forward. So thank you very much, everyone. I really appreciate you joining us. Thank you very much until we have another event soon.
Thank you. It's really a pleasure addressing all of you.
Okay.
Thanks a
you
lot,
for
Girish.
everyone to organize this. Really appreciate it. Thanks a lot for organizing this.
Thank you.
Thank you.
Thank you, Mr. Hussain. I forgot to thank you earlier.
Yes, Mr. Girish. Thanks for coming and presenting.
Thank you.
Sri Lankan Business Council in Dubai and Northern Emirates.